So during this last crypto bull run, I was able to turn $30,000 into over $1 million, despite almost every single project I invested into eventually failing and quite a few things going terribly wrong along the way. And the average person wants to excuse that away as some sort of luck or some sort of innate advantage I had in life that allowed me to succeed where others would fail. If somebody becomes a billionaire, we just say, well, they were lucky or they were born into a well-connected family. And if they're a successful entrepreneur, actor, artist, investor, athlete, we say the same thing, that they were just lucky. And that's why the average person remains average. They, instead of learning, excuse away anyone else who's more successful than them. It's never that the other person put thousands of hours of hard work in, was more disciplined than them. It's never that the other person took time to educate themselves, spent years working while their friends were out partying. It's always just, they were lucky. But that couldn't be further from the truth. Luck is when hard work and opportunity meet, and investing is no different. There are certain ways to invest that significantly improve your odds of making money and winning, and there are other more common ways to invest that not only don't improve your odds, but sabotage your odds of winning and cause you to be more likely to lose money. So today I'm gonna share with you the biggest mistakes that people are making in investing and why most people are investing all wrong. First up, one of the biggest mistakes the average investor makes investing is not understanding position sizing. This is such a simple concept, but also an extremely powerful concept. Still, most people completely dismiss it and get absolutely wrecked. But the smart investor who implements a solid position sizing plan is able to protect themselves from getting destroyed and is able to take advantage of opportunities that allow them to make a fortune. Correlation Ventures did a study of 21,000 different venture capital deals. Of those deals, 65% lost money. 2.5% of those deals made a 10x to a 20x profit. Only 1% made more than a 20x gain. And out of all those deals, just 0.5% of those deals made a 50x or more return. Meaning, even with professional venture capitalists, 65% of their investments are actually failing. The way that a venture capitalist makes money isn't by having every investment they make be a success. It's by spreading their risks out and having a small percentage of the investments they make account for the majority of their profits. They might have out of 10 investments, 6 of those investments outright fail, 2 of them break even and do just okay, 1 of them does kind of decent, and 1 of them does so good that it makes up for the 6 losses and turns a profit. The point is that the biggest gains often only come from a small percentage of your investments. And you can't expect all your investments to win. That's not gonna happen in venture capital, that's not gonna happen in crypto, and that's not gonna happen in the stock market. So when I formulated my investing strategy during the last bull run, I didn't just take all my money and throw it at 1 or 2 projects that I thought would succeed. Instead, I spread my investment across multiple different investments, making the assumption that 6 out of 10 of my investments would outright fail, 2 would break even, 1 would do okay, and hopefully 1 would do extraordinary. And I had quite a few projects that I thought were great. I thought they were amazing projects. I invested into them and they ended up absolutely tanking and losing me a ton of money. And I had other projects that I thought were just like, okay, they were just maybe a good project. I don't know. They passed all my filters, so I threw a little bit of money in them. And sometimes those ones would skyrocket and absolutely surprise me, making 10x, 20x, 30x gains. When your emotions get involved, you can't count on yourself to be subjective. You're always gonna get overly excited about some projects and put too much of your portfolio at risk by investing in those projects. And if you invest all your funds in 1 investment or 2 investments, the next time a good opportunity comes up, you won't have any money to invest in that opportunity. And unfortunately, investments don't tell you up front how they're gonna perform. It's not like you're gonna look at an investment and it's like, hey, I'm gonna do a 20x for you, or I'm gonna absolutely plummet and lose you all your money. You have no idea which investments you're investing in are gonna go up or down. So you have to invest in a way that manages your risk and allows you to get into opportunities you might not have gotten into before. Essentially, you have to assume that your judgment calls are probably a good amount of the time going to be incorrect. Even the best investor isn't perfect and is bound to make mistakes. So make sure you manage your risk in a way that allows you to succeed regardless of that. The second big mistake that I see a lot of people make is they pay way too much attention to price action and not enough attention to fundamentals. What I mean by this is if you're looking at crypto or you're looking at stocks, most people look at the price of that investment, and if they see it's gone up a lot recently, they'll say to themselves, look how high this thing has gone, it must be a good investment. Or they'll see a crypto project or a stock that's recently dropped a lot in price, and they'll say to themselves, wow, this thing's dropped a lot in price recently, it must be a bad investment. That's called paying attention to just the price action, and there are a ton of traps you can fall into investing this way. For one, you'd only be investing in a project once it's already gone up a ton in price. So you'd automatically be missing the best gains and putting yourself at a higher risk. Since recently this project went up a lot in value, it's really easy when an investment goes up fast and quick for it to come down fast and quick. On the other hand, avoiding investments that have recently gone down a lot in price can also be a massive mistake. Bitcoin and Ethereum after the 2017 bull run dropped massively in price. Bitcoin went from $20,000 to just $3,000, and Ethereum went from $1,400 to just $88. Looking at just the price action, you would have avoided these investments because you'd have been like, look how far they've fallen, they must be bad investments. But you also consequently would have missed out on an opportunity of a lifetime, as Bitcoin later went from $3,000 all the way up to almost $70,000, and Ethereum went from $88 all the way up to almost $5,000. Instead, you should use price action as simply one indicator in your assessment, and look more importantly at fundamentals, such as what is the project or investment trying to do? What problem is it trying to solve? What value does it bring? How much revenue does it bring in? Where is it going? Who's the team behind it? What market conditions led it to go up or down? And will those market conditions be changing in the future? I had quite a few projects that I sold when everyone else said they would only go up, and quite a few projects I bought when everyone else said they would only continue to go down. And so far, adopting this mindset has allowed me to win big. Paying attention to fundamentals as well as price action allows you to see what the average investor can't and gives you a massive advantage in the market. Reason number 3 that people are investing all wrong is they get overly attached to their investments. They get disconnected from reality and start to believe that their investment will only continue to go up forever and ignore any criticism or warning signs surrounding that investment. This happened with Terra Luna, where a lot of people tried to point out faults in the system, but the core team behind the project didn't want to hear it. They didn't want to listen to it. They excused it as nonsense, as people trying to attack the project, as people trying to FUD the project, as people trying to undermine the project. And this also happened to me when I sold my Titano after noticing some major issues with the project. When I tried to point these issues out, I was immediately attacked and branded a traitor. Some people accused me of betraying the project by selling my investment and pointing out flaws in the system, insisting that I should be loyal to an investment. Those people became too attached to the project, no longer seeing it as an investment, but as somewhat of an extension of their personal identity, removing their ability to properly assess the investment. Of course, when I issued that warning, anyone could have sold that project between 6 and 10 cents. But today that project sits over 10 times lower at less than a cent. Those people that ended up becoming too attached to their investment ended up losing a lot of money. Reason number 4 people are investing all wrong is that they don't have any sort of risk management strategy. And this is maybe one of the worst errors you can make investing. And it's a key factor in why I was able to succeed in some investments that other people failed in. Without a risk management strategy, you're essentially gambling with the odds heavily stacked against you, especially if you're investing into low market cap, high risk assets with an extremely high rate of failure. When I invested into projects like Strongblock during DGen crypto season, I had a simple strategy that I followed to manage my risk well. I would take my risk off the table as quick as possible, no matter what happened, and then I would take profits along the way. While other people compounded their nodes and told me I should be doing the same because I was missing out on so much money, I stuck to my strategy and took my risk off the table as quick as possible, eventually taking my initial investment off the table and then taking profits along the way. And with all my other investments, I followed a very similar strategy. Every time my investment doubled, I would take my initial off the table and then let the rest ride, taking profits along the way. I followed this strategy with Terra Luna when I invested $760 and it absolutely skyrocketed. I took my initial off the table and then I took profits along the way, totaling about $15,000. And I felt so dumb when my $760, even despite me taking profits off the table, grew to over $150,000. I kept doing the math and thinking, wow, if I wouldn't have taken profits off the table, it could have grown to over $300,000. But then as we know, Luna absolutely collapsed and my Luna was staked, so I couldn't remove it, I couldn't sell it in time. And in a matter of days, my $150,000 eventually dropped to less than a cent. Then obviously, I was really thankful I had stuck to my risk management strategy, taking my initial off the table and taking profits along the way, which just goes to show you really never know what's going to happen and you should always stick to your risk management strategy regardless. Reason number 5 most people fail is they treat short-term projects like they're long-term projects and long-term projects like they're short-term projects. And I made an entire video about this if you want to check it out, but basically people will invest into short-term high-risk risk projects thinking they're the next big thing and planning on holding for forever. And on the other hand, they'll invest into long-term, strong fundamental projects, expecting them to double overnight, and when they don't, they'll sell, thinking it was a total dud. I did a lot of crazy crypto experiments with really high-risk crypto projects, sticking money in and seeing if I could turn a profit. I did extremely well with this because I recognized those projects were short-term projects with extremely high risk, and I handled them accordingly. You need to understand the type of asset you're investing into, its risk, and its lifespan if you want to come out on top. Reason number 6 most people fail is that they don't have any sort of exit strategy. Their investment could go up or down, but they don't ever have a plan on how they're actually going to make money. Their strategy is simply, I'll buy it, I'll hold it, and I'll see what happens. And the problem with that is, in the heat of the moment, it's really easy to get really excited or really fearful depending on the situation, and end up making a split-second decision that could cost you big time. You should always go into an investment knowing at some point you're going to sell and take a profit. That's the whole point of investing. Reason number 7 most people are investing all wrong is that they don't take time to examine the macro picture or the big picture of the market. For example, something like crypto operates in seasons. In some seasons, Bitcoin alone goes up. In other seasons, all the blue chips go up. Still in other seasons, all the degen projects go up. And in the final season, everything crashes back down to earth and the whole process starts over again. And each season requires a very different investing strategy to be successful. You don't want to trade degen projects while the entire market is collapsing. And on the other hand, you probably shouldn't be buying Bitcoin expecting it to triple in value when it's degen season. During crypto winter, the goal is to preserve buying power and to hunt for good opportunities before the next bull run. On the other hand, during crypto summer, the goal is to be invested into a wide range of projects so you can benefit as the majority of the market moves up. On top of that, when looking at the big picture, you also want to understand what causes bull markets and bear markets. What's affecting the wider market? Why is it affecting the wider market? Will it always be that way, or is it just temporary? All these things play into the differences between bad investors and great investors. Reason number 8 people are investing all wrong is they only invest in something when it's popular and they leave when it declines in popularity. This is a huge mistake and essentially guarantees that you remain average because you're investing just like and at the exact same time as the average person, meaning you'll get the same average result that everyone else gets. I made an entire video about this concept as well if you want to check it out. Lastly, maybe the biggest reason that most people are investing all wrong is they're not willing to put in the hard work to give themselves an edge over the rest of the market. And that's because the average person's kind of lazy. They want a six-pack, but they're unwilling to change their diet and lifestyle. They want to make $1 million investing, but they want to do it without doing all the research, educating themselves, and doing all the hard work that's actually required to make $1 million investing. Most people do zero research when investing and simply invest in something that a friend recommended or a company that they like. But you can gain such a massive edge by being the one who's willing to do the hard work, by being the one who's willing to put in the research time to actually understand the thing you're investing in. If you really want to win, you can't skip this step. Yes, it's hard. Yes, it's not easy, but that's why it's an advantage because most people are unwilling to do it. As always, none of this is individual investment advice. I have no idea who you are on the other side of the screen. I have no idea what your situation is. This is all meant for educational purposes. Take the things that make sense and get rid of the things that don't make sense for your situation. If this video was helpful, make sure to hit that like button. If you have any questions or comments, let me know in the comment section down below. And if you want to see more videos like this, make sure to hit the subscribe button. And you got to also hit the little bell next to it if you want to actually be notified each time I release a video. Thanks for watching, and I'll see you next week.